this webinar that's meant as a prelude to the Money, Metals, and Mining Alaska cruise that all of your speakers today will be participating in. And what we're going to do is get the views, or the current views on the gold market and mining shares from all of our speakers. And obviously it's only scratching the surface of what you'll be able to get on the cruise, which will entail 7 days of voyaging to Alaska, from Alaska to Vancouver, and exploring the majesty of the Alaskan wilderness. But also you'll have the opportunity to get the latest ideas from our speakers being Brent Cook, who is the editor and publisher of Exploration Insights. Brent focuses on the mining stocks, particularly junior mining stocks. Mike Larson of Money and Markets at the Weiss Publishing Group, who's more of a generalist, focuses on the money markets and interest rate regimes, and has come to gold as a generalist. And myself, Brien Lundin, I publish Gold Newsletter and host the New Orleans Investment Conference. And Rick Rule from Sprott Global, who's acclaimed as one of the foremost experts and resources really in the world today. As I say, we'll be attending the Money, Metals, and Mining cruise, and over the course of those 7 days, you'll get the opportunity to bend our ear and mingle with the speakers and your fellow cruisers, and really get some of the best investment ideas in this sector as we turn, or appear to be preparing to turn, into another bull cycle. With that said, I'd like to start the agenda today by reviewing where we are in the gold market, some charts that I prepared. Here we have the early year gold rally so far this year, and as you can see, it started in mid-December, really right after that Fed rate hike announcement, accelerated through January and February, and in March began to trade sideways a bit. As you can see, we're in a bit of a flag pattern. As some of you may know, that's at some point when a market consolidates in this type of pattern, it's going to break either higher or lower. The predominance of instances, it agrees with the prior trend. So there is an argument here technically that we're going to break out and continue the trend higher. Here we see the gold stocks, and you'll see that they delayed a bit in January, mid-January, to take off into the, but once they did, they accelerated and multiplied the gains in gold. They also, although not displaying a flag pattern or trading sideways over the past few weeks, and we're kind of waiting to see how this will resolve. A couple of other charts real quickly. Here's gold with its 50-day moving average and Bollinger Bands. Looking at this chart, if you see where the arrow is, it would not be surprising if gold would retest the top channel of the old trend line. That channel would be around 1190, which means gold would break $1,200 on this consolidation. There's also a important resistance, previous resistance around 1180. So we're looking at around 1180 to 1190 if there is a correction, according to this chart, as kind of a target for that correction. Here we have a chart showing the 14-week stochastic for gold, and one of the things you should note here, the reason why I brought this chart along is since the peak in 2011, right here, we've seen very sharp reversals in gold, up and down, as the stochastics show. However, during this long bull run from 05 to 011, you see that these peaks are more elongated, wider, last a bit. What we're looking at right here is that we're at another peak in the stochastic. For this to really confirm that we're in the long-awaited breakout from the bear market, I believe we need to see this latest peak in the stochastic prolong itself and have more of a wider top to it. So really, it seems like we're always at a crucial turning point for gold, but we really are right now. The next few days, the next few weeks will determine whether this is the real breakout that we've been waiting for so long, or whether we have a bit more time to go. With that said, I'd like to bring on Mike Larson to discuss some charts that he has. Mike?
Hey, thank you, Brian, and thank you for joining us, everyone. As Brian mentioned, I'm a bit more of a generalist. I look at the gold market through the prism of what's going on in some of the other markets out there, currencies and interest rates and sort of the economic backdrop. And what I've noticed, especially since the low in the stock market in mid-February, which was sort of accompanied by this big surge in gold, is that we're seeing a lot of trades that I would consider loss of trust trades in central banking and in market stability overall. While yes, the overall market has bounced back, it's not being led at this phase of the rally by sort of the traditional economic growth, everything is rosy, financials, industrials, technology, and so on stocks. It's more the what I call safety plays, the safe yield names, the distrust names in the market. And I just picked one out of the hat here that kind of shows this trend. This chart shows Campbell Soup. I mean, this is a company that's been around obviously for decades and decades. It has a boring product. It just sort of, it's a dividend play. It's sort of like what would be in sort of the grandmother's portfolio, and yet it's been trading like almost like a souped-up tech stock, if you'll pardon the pun. And I think that I find it kind of telling that these safe yield, buy me protection type stocks are rallying right alongside with gold. It's sort of indicative of this environment where central bankers are kind of losing control of the markets, and investors are looking for anything that can protect their wealth and build their wealth in such an uncertain, volatile environment. So that's what I'm seeing again in this example of Campbell Soup. And some of the other charts that I have also point to that same trend. This was just basically a look at the year-to-date gains and losses in a number of different sectors, sub-indexes for the S&P 500, as well as some of the popular ETFs out there. And these percentages are good through a couple days ago, and you can see the market vectors gold miners ETF, ticker symbol GDX. That was up 46% just year-to-date. Basically one of the best performances in decades for gold mining stocks. But then if you look at the subsectors in the S&P 500, what's leading in terms of those sectors, and it's telecommunications services, the high yield, steady Eddie, AT&T, Verizon type names. That index was up almost 16%. The utility sector was up almost 14%, which is, there was a great Bloomberg story that pointed out that was the strongest relative performance of utilities to the overall market going back since their data started in 1989. Consumer staples, again, the names like Campbell Soup and some others up about 5%. A little bit of a bounce in the junk bond sector, but not much. And then you look at some of these, again, these sort of economically sensitive or growth sectors, whether you're talking about the QQQ for technology or the XLF for bank stocks or the IBB for biotech, all of those are bringing up the rear. And again, I think that tells you we're in a very uncertain environment where people are seeking protection. They're seeking something that they can trust to store value. And I believe that's one of the reasons why gold's been performing very well. And again, if we move on to a couple of the other charts I have here and just touch on those, what I also find interesting, if you'll pardon the pun on interest rates, is that this is a chart of the 2-10 Treasury yield spread, basically the difference in yield on a 2-year Treasury note and a 10-year Treasury note. When there's a lot of optimism about growth and about stability and so on, and down the road, again, sort of a more stable growth environment, this spread tends to widen out. What you can see on the far right is that this key interest rate spread has collapsed. We're basically at the lowest level since 2007, which, as you probably recall, was the peak of the last economic expansion and when things started to come unglued in housing and banking and so on. And again, instability and volatility reigned after that point. So the fact that this spread has been coming in quite a bit and has really not rallied hardly at all along the stock market, again, tells me we're still in that high volatility, high uncertainty environment overall. And again, you're seeing that confirmation in some of these other markets. And lastly, if I look at the final chart that I have there, speaking of the underlying economy, and one of the reasons why I think people are turning to gold and turning to some of these safer yield plays is that there's no end in sight for this interest rate environment where you have basically financial repression. The Fed is not really keen on jacking up interest rates here. The Bank of Japan has pushed interest rates there into negative territory. Obviously, that's been going on in the European Union. The ECB has been doing that for a while now. And so what's happening? People can't earn anything, so they're socking away more money. They're not spending more. They're not going out there and aggressively borrowing and spending. They're actually saving a lot more in this environment. This personal savings rate is at its highest since 2012, which is what this chart shows. So along with that uncertainty, you also have a yield situation that's actually favorable for gold. I mean, think about it. One of the historical knocks against owning gold has been, well, it doesn't yield anything, whereas I can make whatever, 2%, 3%, 4% on a bond of some sort. Well, in a negative interest rate environment where rates are at like negative 0.4% in Europe, they just went under the zero bound in Japan, and there is definitely the risk that down the road that even the U.S. could have negative interest rates. I mean, that means you're actually paying the bank to hold your money. You're receiving less than zero. In an environment like that, the 0% rate, for lack of a better term, that gold pays is actually advantageous. It's better than losing money. So I think, again, in this environment, there's a lot of fundamental reasons and confirmation from other markets beyond just the fundamentals of gold that are very supportive of the metal over the long term.
You know, Mike, you bring a very good point. In this low interest rate environment where with negative interest rates, gold is the highest yielding investment. I saw the World Gold Council actually came out with its report last week on gold in the age of negative interest rate. And one of the things that they noted was that more than half of sovereign debt today is trading at a negative real yield when you factor in inflation. The vast majority of the rest of sovereign debt is between 0 and 1%, and there's only 16% of the world's sovereign debt right now is trading at above 1% on a real yield. So that's the kind of environment we're in. You know, it's new, relatively new for the world to be in a negative interest rate environment, and no one really knows what the consequences, intended or unintended, will be. But one of the most obvious is that if they're charging you rent for your money in a bank account, they are essentially paying you to buy things, and they want you to buy things. They don't necessarily want you to buy gold, but with so much concern and fear in the air, gold is the natural alternative. And,
yeah, absolutely.
Yeah, and you look at it, Mike, from a broader generalist point of view, and really what you're looking at is looking at the demand for gold because of the global economic situation. You can't find more of a specialist around than Brent Cook, who is a geologist and focuses on the supply aspect of gold, and in particular discovery and discovery stories. Now, Brent, this is one of your a chart that you've published in your publications a couple of times that I think is very interesting and is really irrefutable from the supply standpoint. Can you explain this to us?
Yeah, Brian, this is to me where it gets really interesting, in that about 20 years ago we had the peak in discovery of new gold deposits, and that was a result of, you know, most of the world opening up to exploration in areas that wasn't previously being explored or couldn't be explored for political reasons or whatever. Most of Africa, a lot of Eastern Europe, parts of South America as well. Well, those opened up, and geologists went out and were able to pick up the low-hanging fruit, if you will, being the deposits that were sitting at surface that have never been tested with modern methods. That's what resulted in this peak in discoveries in about 1995. Since then, discoveries have been declining overall, as you can see in this chart, despite the fact that we're spending more money looking for these, and despite the fact that the gold price in general has been going up. So the slide on the right side, the peak production, is really a function of these discoveries, the larger ones that were discovered 20-odd years ago, being in production right now. And it takes, on average, between 10 and 20 years from discovery to production to bring a gold deposit into production. So what that means is this lack of discovery you're seeing here on the left side is really going to get critical when you start looking further out into 2020 and beyond, and that there's no new projects that are really going to be coming to fill that gap. And right now we're producing in the order of 90 million ounces a year. We're finding in the order of 40 million ounces a year. So that 50 million ounce gap just keeps getting bigger and bigger. And that to me is what's really exciting, is that if you can identify the companies that are in the early stages of making a significant discovery, that's going to be a very valuable asset going forward.
Yeah, and you know, if you look at even some of the, I guess, very conservative organizations like the World Gold Council, Goldfields Mineral Services, etc., they're all talking about the fact, finally, that we have actually reached peak gold. I believe in the last quarter of 2015 that on a quarter-by-quarter basis, gold production was down about 3%. And so we're not going to be making much more gold, or as much gold going forward as we have been in the past, and that will eventually have an impact on prices. Brent, I'm going to go to your next slide here, which I think is very important as well, on the when you actually buy into a gold stock, because that's important as well.
All right, great. Let me make one clarification on that peak gold story. This is not like peak oil and that sort of thing. We're not talking about a dearth of gold. There's 3 trillion ounces of gold in seawater. The problem is that there's a real lack of economic deposits.
Right.
The Earth just didn't make that many economic deposits. Are getting harder and harder to find. So in theory, there's no shortage of gold. What there's a shortage of is economic gold deposits. I just want to make that clear.
Yeah, and a finer point that you put on it, because you pushed back on me when I've made this point that if the price rises and more gold will come, your point is that that's not necessarily the case with gold as it is, say, with oil and fracking and the like.
Precisely, because most of the deposits that are out there are sub-economic or mediocre. They've got problems that an increasing gold price really probably won't fix. And those are metallurgical issues, social political issues, environmental issues, capex issues, strip ratio issues. All those issues really don't get fixed by an increasing gold price. So despite the fact that I can point to, in fact, I've got a spreadsheet open now, 58 gold deposits on it. Of those that aren't developed, maybe 12 probably work as a decent deposit. So anyway, that's sort of the point I want to get across is if we can find one of those 12 and own them, we're in good shape.
And again, when you buy these companies is critical.
Indeed, and that's what this slide's about here is this is sort of theoretically what the share price looks like of a junior exploration company from initiation of a concept through to drilling, through to discovery, and then as it moves into the second phase, which is the technical work and into production. The big jump in this occurs basically when we see drill holes that begin to show that we might have a deposit. And that's where it says interpreting news releases, which is critical. On average, if you look across the board, maybe 1 out of 1,000 metal prospects, metal anomalies, becomes an economic deposit. So as a speculator in this industry, it's critical to know when a deposit is not looking like it's going to work. And that requires some detailed analysis of the data. But if we know most of them are going to fail, that tells us that most of the initial appearances of a discovery are eventually going to run into problems, be it metallurgical, the ones I mentioned, social, economic, that sort of thing, or size limits. So we can make, and I have, and so has Rick. In fact, when I used to work with Rick, we made decent money buying companies as the discovery looks like it's happening. But as we start to detect problems, get out of the project, get out of the company, make good money, and before it fails and drops.
Yeah, and not just before a project fails, but at the right point in that curve when most of the profits have been made.
Precisely. Precisely. I think people tend to get more and more excited into a stock as it's rising, but at some point your valuation exceeds what the real value is. And then the stage where you go from, okay, we've defined a deposit, we've got a resource, Now we've got to do the technical work, being the call it less exciting engineering work, flow sheets, that sort of thing. That takes two plus years to produce a feasibility study. During that time frame, most of these stocks back off. And there's a second point there. You can see where once the feasibility study is done or close to being done, it's been de-risked quite a bit. And assuming it is a good deposit, there's a second shot there of making money off the same stock or discovery.
Yeah, and what you're looking at here are the cycles in an individual stock or an individual company making a discovery. And I think that's one of the keys to the gold market and the resource stock market, is that you have cycles in the resource stock market. You have cycles in the process of discovery and exploitation. And you also have cycles for the underlying commodities. And Rick, you know, since I've known you, I'm trying to think, we've probably been through 3 full cycles in the gold market and the mining stock markets. And one of the things that is really, I think one of the defining characteristics of these markets is that they are so reliable. The timing may vary a bit, but you do have these cycles from highs to lows. And if you can get in on one of the lows, which is your specialty, and sell at the highs, which is also one of your specialties, the profit potentials are really absolutely enormous. I mean, for the average junior gold mining stock to get back to the 2011 levels, just to those levels, the average stock will have to multiply 6.3 times in value from today's levels. Now that sounds very exciting, but when you realize that the better companies on this list, the kind of companies that you, Brent, I, and Mike can pinpoint or have been able to pinpoint in past cycles, those stocks are going to go up 10, 20, even 30 times in value for some of them.
I think that's an important point, Brian. The truth is, as you suggest, it's an extremely cyclical industry. And it's worthy to note, I guess, that in the average bear market decline, the TSXV resource index falls by 50 or so percent. The decline that we've just experienced fell by 50%, and then it fell by 50% more. And then to kick us while we were down, it fell by another 50% to be off an astounding 90% peak to trough by some estimates. Yeah. That's the bad news. The good news is, as Ned Goodman has pointed out, in the normal market, over a 5-year period, you lose 50% in the down cycle, and if you're any good at all, you make 1,000% in the up cycle, which means over the course of a decade, in fact, you make 500%, which isn't bad 10-year performance. But if you measure it from the market bottom, it's truly extraordinary performance. The second thing that you said, Brian, that needs to be reiterated for the people who are listening to this presentation is that almost all, about 80% at least of the performance accorded to the speculative indexes, the TSXV, is enjoyed by the best 20% of the companies. So when you talk about an index that falls by 90%, what you really do is understand that a bunch of the companies in the index go to zero and some perform less poorly. But more importantly, on the way up, almost all of the performance is done by a fairly small group of the companies. The benefit, I think, of this cruise to people who are interested in the sector is not so much our discussion about gold, although the gold discussion will certainly reinforce people's bias to participating, but more in terms of discussing what separates the good from the bad, from the ugly, with regards to the ways that you participate in the sector. Let me be more specific. With regards to the gold discussion, I think what you need to look at, and I really think Mike did a good job of this, is describing gold versus what I might call anti-gold, the U.S. 10-year treasuries. I believe that gold trades inversely to them. And the U.S. treasuries are unattractive in terms of real and relative yields, which has made gold doubly attractive because, as Mr. Larson pointed out so well, the holding costs associated with gold are at historic lows. But I don't think I need to sell the attendees on the panel, to this panel discussion, that gold is an efficacious investment. It might be more challenging to sell participation in the TSXV, where the market is off by 88%. Mm-hmm. Of course, one's expectation of the future is set by one's experience in the immediate past. And if you look back at least to 2015, our experience was horrific, which means that our anticipation was horrific. But remember that a market that's off 88% in real terms, where the factors behind the market haven't changed much at all, is precisely 88% more attractive. And I think that's something the attendees need to focus on. I also need to reiterate that the bare numbers around the indexes disguise the fact that most of the participation in terms of the upside and the downside is concentrated. And the best 20% of the companies, or better yet, the best 5% of the companies, will generate all or substantially all of the performance. So concentrating one's efforts, concentrating one's portfolio picks on security analysis rather than sector analysis will pay real benefits. And finally, with regards to the last 3 months where the gold performance and the gold equities performance has been very good, when people ask, have I missed the boat? The answer is decidedly no. Remember that this is a market that's recovered just a little bit of its loss. Remember also that the equities outperformed the metal as one would expect them to, because the equities were oversold relative to the metal. In other words, they had catching up to do. Remember further that the rally that we've seen thus far in the equities has been semi-concentrated. The biggest market cap performers have been Newmont and Barrick, which would suggest that a whole bunch of the move in gold equities has simply been generalists rebalancing into gold because it's the one sector that sort of performed in the market in the first quarter. Expect follow-through, and then expect the follow-through to be concentrated on the type of companies that Brent has described, not the lame, the halt, and the blind, which constitute most of the index, but in fact the people who are making the increasingly valuable discoveries and generating real wealth. I think the benefit that people will get from participating in the cruise is simply the fact that, as an example, the cruise originates in Vancouver, which is a town that's sort of steeped in gold and exploration. It's a place where gold discussions take place in the coffee shops. It's a wonderful place to start. Also, because I don't think that the cruise will be focusing so much on gold as a topic, but rather how to outperform your peers in the most speculative but most rewarding part of the gold exploration sector. That's what really excites me about participating in this excursion at this particular point in time. I can't imagine a better time for this exercise.
And you know, Rick, I rarely find the opportunity to correct you, so I'm going to take the opportunity when offered. But the cruise actually ends in Vancouver, begins in Anchorage and ends in Vancouver, and that brings up the point that we'll also have a one-day symposium in Vancouver, where we'll also hear from Peter Schiff, from Eric Coffin, Gwen Preston, and some highly recommended companies as well. But you know, one of the things that I get from what you just said, Rick, is not just that you need to focus on the winners in this next upcycle, and that's where the majority of the gains will be found, but you need to avoid the laggards. You know, I found Brent's issue of his newsletter this week especially valuable, because one of the things he went through is, I think you titled it, Brent, is Making No Friends. He went through a few widely held junior mining stocks and exposed what was, in your opinion, fatal flaws in those companies or in their projects that you're uniquely able to do as a geologist and as an experienced geologist in this area of exploration. Can you comment a bit on that, on avoiding the losers in this next cycle?
Yeah, thanks, Brian. I think that is critical in this sector, I said before. most of these projects are never going to come to fruition in terms of making an economic deposit. So my job in the letter, and our job as speculators in the industry, is to find the fatal flaw in a project as quickly as possible and move on. Often you can find that and still have made money in the stock, but regardless, once you find a fatal flaw, it's critical to get out of the way. So what I did in this week's letter was went through, I think, 5 different companies that are getting a lot of publicity out there,
Right.
And walk through where that fatal flaw was, what the problem is, so that it would help not just people avoid those stocks, but see how to evaluate other stock opportunities that get pushed their way. I think that's really key, and that's something that I look forward to talking about on this cruise as well.
Yeah, because if the average stock is going to go up over 6 times in value to equal past cycles and not exceed past cycles, you're going to have the laggards, you're going to have the companies that will underperform, and that will drag down your greater portfolio. It's vitally important to avoid those, because you really, a market like this is ripe with opportunity for companies that have the potential to be 10 and 20 baggers, and you really need to focus on those ones. And the rewards, as we've seen over and over again, can literally be the kinds of things you never equaled in your investment career. I'd like to touch on one thing regarding getting back a little bit broader to the gold market in general, and really the financial markets worldwide. We've had over the past week a lot of confusion in the market, and as we know, the markets do not like confusion. But last Tuesday, we had Janet Yellen give a speech to the Economic Club in New York that was wildly bullish, or at least interpreted thusly by the markets. And that was a bit in response to a number of Fed presidents rather, who had been talking a bit hawkishly over the previous couple of weeks. And now, in the weeks since Yellen spoke, we have some Fed presidents coming out and speaking hawkishly again, seemingly contradicting Yellen. And it appears that there's some dissension or potential dissension on the FOMC, and this, I think, has some real implications for not just gold but the broader markets. Mike, do you have any views on that?
Sure. As you mentioned, I think the Fed, it seems like from one day to the next, depending on what speaker's coming out there, they can't seem to get their message straight. They don't know what they want to communicate or how they want to communicate it. And I think that just speaks to the environment we're in, where it's incredibly volatile, incredibly uncertain, and incredibly dissonant messaging coming not just from individual members of the Fed. Janet Yellen's sort of trying to herd cats amongst the regional Fed presidents and the Fed board in Washington and so on, but really amongst central bankers the world over. One of the reasons we're in this environment that's so tumultuous and so volatile of late is because you've got the Fed doing one thing, the European Central Bank doing another, the Bank of Japan doing another, and then all these minor central banks all over the world going in their own direction. It really is, again, in monetary policy terms, I've almost never seen anything like this. I mean, again, you mentioned the vast percentages of government bonds that are yielding 0 or less than 0. I mean, we've never been in an environment, a monetary environment like that in world history, essentially. And that tells you that the potential for kind of pushing back and investing in things like gold that are designed to protect you from that kind of volatility and that kind of uncertainty really is historic here. So I think that the Fed's having a very difficult time trying to figure out what it wants to do, what it wants to say, how it wants to say it. And again, you have, when it comes to the stock market overall, you had basically the worst start to any year in the Dow Jones 118 some odd year history, followed by the biggest, shortest term, fastest rally in 118 years of Dow history. That simply isn't a normal environment. That's not what you see every day as a stock market investor. And I think that's one of the key reasons why people are really looking for safety, looking for security, looking for some other way to protect themselves from kind of this never before seen policy environment we're in.
Well, one of the things that I know Peter Schiff harps on this repeatedly, and I agree with him, is that the Fed keeps pushing on the rope of monetary policy, and all the other central banks as well. They keep flooding the markets with money with low interest rates, and so you never break the fever, as it were. You never allow the markets to reset and work off the excesses of the previous cycle, and you're just extending this period of malaise and underperformance, and all you're really doing is driving up assets like equities, and in some cases during the cycles commodities, and not having any effect on the underlying economies. So what do they do when this doesn't work? They just ramp up their efforts and exacerbate them and do even more of what hasn't worked previously.
Yeah, I mean, it's the Einstein definition of insanity, right? Doing something over and over and expecting different results, and that's definitely the policy environment that we as investors have to cope with here.
Yeah, Art Cashin made a point a few weeks ago on CNBC that in over 100 years there had only been 3 instances of where the U.S. stock market had corrected 10% twice within close proximity to each correction. One was 1929, one was 2000, one was 2008, and then in 2015 and 2016 we had the 4th instance. Now his argument was that we really shouldn't expect much out of this year from the stock market, if that's any indicator, but my takeaway from that was that you've only had that situation occur 4 times over the last 100 years, yet 3 of those instances came in the last 15 years. So to me, that proves that we are in an environment of higher volatility and markets that are manipulated or attempting to be manipulated by central banks.
Yeah, absolutely. I mean, again, it's the policies that are being pursued now are so experimental and so far out on the curve that nobody really does know what the consequences are going to be. I mean, you look at when you have in Europe the most recent negative interest rate announcement, what happened? I mean, bank stocks, European bank stocks basically fell out of bed. They're trading at levels that they haven't seen, or they're trading at levels even lower than we saw in the depths of the financial crisis in 2008, 2009, because the very central bank actions that are supposed to help the economy are actually crushing profitability throughout the lending industry. And that's just one example of the unintended consequences that are out there for the markets to deal with.
Yes, and again, in a negative interest rate environment, the powers that be are trying to get you to take your money out of your savings and spend it on something. I don't think they're bargaining for that something being gold, but then again, central banks themselves are buying gold. So, that's I say that, but Canada just sold the last of its gold reserves a few weeks ago, and that's reminiscent of 1999 to 2000 when Gordon Brown sold the Bank of England's gold reserves, and that marked that long-term bottom in the gold market. I'm looking at this, and I said in my newsletter this month that I'm looking at this as the Trudeau trough, possibly a bell that's rung at another bottom in the gold market.
Absolutely. I mean, the patterns out there in gold look more encouraging than I think I've seen in quite some time. So I'd have to agree.
Now we're starting to run toward the end of our allotted time for the symposium, but what I'd like to do is try and sum up the situation now as we see it. What we have is a situation where we have declining gold production. I think Brent's outlined that very well, and we have corroborating evidence, of course, from the major gold associations that track global gold production, and we see that production has peaked and is falling. At the same time, we have dramatic increases in gold demand due to the widespread global uncertainty and the potential that the U.S. is going to slide into an economic deceleration, potentially a recession, to join much of the rest of the world. And if that happens, then we're going to see the Fed have to reverse its supposed normalization of interest rate policy and backtrack, return to quantitative easing to some degree, lower the rates by all of a quarter point maybe that they have headroom for, and perhaps go negative. if any of that happens, we're going to see gold prices, gold demand just absolutely catapult, and so will gold prices. So we're looking at it from a long-term basis as there's very little downside risk. As Rick touched on, this market is down, especially in the equities, is down some 86%. Now that translates to less risk, but it also translates to tremendous upside potential if you just have a reversion to the mean. And that's what we're going to look at, is that happening, whether this is the big breakout right now in gold that we're experiencing at this very moment, and that will be confirmed over the next few weeks, or whether the breakout takes a bit longer, where we have to go a few more months down the road or even a year or so. The upside potential is so exceptional, and it is so reliable in these types of cycles that those who go on this cruise and attend our symposium following the cruise in Vancouver are really going to have an inside track on some stocks and opportunities and strategies that could be among the most rewarding in their investing careers. With that said, does anybody have any other closing remarks that they'd like to offer on the market as we see it now? No, I guess we're all in agreement then, aren't we? Good, good. Listen, everyone who's attending this, if you can if you look at the last slide up here, there's an 800 number where you can get more information on the cruise. It's really going to be an exciting time. You get to mingle with not only the speakers and the experts, but the attendees that I've found on these cruises are some of the most successful and knowledgeable investors to be found anyway. And you get to make lifelong friends on these events and really learn a lot, not just about specific tips and specific strategies, but how to approach the markets in general, that I think just offer tremendous benefits and tremendous enjoyment in the company of fellow investors. So I think that takes it from us. Mark, are you on?
Yes, I am. We do have just a couple of minutes here remaining. I had a couple of questions that came in, if you wanted to
yeah, absolutely.
Take a little bit of time to answer these. We had someone who was interested in seeing if they would do you think they'd make more money buying gold bullion or gold stocks?
Well, in a gold bull market, you will make more money in gold stocks, provided you're not very narrowly focused on a few gold stocks and the wrong gold stocks. But I think all of my panelists will agree that you should have a widely diversified portfolio within the gold sector, and that means gold and silver bullion. That means other aspects depending on how speculative you are, but at its most basic level, you should have a core holding of gold and silver bullion just kind of put away in case of emergency and considered as insurance. From an investment standpoint, yes, gold stocks typically leverage the metals on the way up and on the way down. Rick, I know that you've given people a lot of advice on this in your career. Do you have anything to add on that?
Yeah, I do. I think it's really a function of the individual. If the individual is willing to do a little bit of work and assume some business risk, the gold stocks will perform better. If you are not willing to do the work and just need to be in the sector, then you need to be in the gold. The truth is that investing in gold stocks requires that you either do security analysis or have access to people who you trust and understand who do securities analysis. And I suspect that participation in this cruise would be most beneficial for people who want access to the presenters and some of the attendees who will themselves be pretty accomplished investors who are doing and are willing to do sufficient securities analysis that they can avail themselves of the inherent outperformance of a well-constructed gold equities portfolio relative to gold.
Good point. Mark, next question.
All right, thank you for that. We had another attendee. They were wondering for the April 19th gold fix in Shanghai. What do you see or predict will be the outcome on that?
I won't hazard to guess. Anybody else would hazard to guess? April 19th? I don't know if there's any particular relevance to that date that I'm missing.
It looks like they were saying China was going to start a gold-based price fix.
Oh, yeah, they're starting a futures exchange, but it's a physically settled futures exchange. I wouldn't hazard a prediction as far as any specific price point, but I do think it deserves commenting on the fact that Chinese gold demand is far higher, or appears to be far higher than the mainstream financial media are predicting or reporting. The Shanghai Gold Exchange started a while back, a few years back, and it's an exchange where every bit of gold produced or imported into China must be sold through that exchange. So it is a very close approximation of domestic Chinese gold demand. And since the gold takedown in April of 2013, demand from China and demand as evidenced by the Shanghai Gold Exchange deliveries has absolutely skyrocketed to the point where last year there were 2,650 tons of gold delivered from that exchange to Chinese citizens. Now that's important when you consider that there's only about 3,000 or 3,200 tons of gold produced, newly mined gold produced annually in the world. So China alone is taking up the vast majority of that gold. If you add in the 800 or 900 tons soaked up by India, then those two countries alone are taking up considerably more than all the newly produced gold in the world, which a figure which in itself is declining. So I think that shows you gets you a snapshot of the situation that we have in the world today. And the Chinese don't produce enough gold to meet that demand, so they're importing gold, and that gold is largely flowing from west to east. So for the past few years, we've had a river of gold flowing from the Western markets, from New York and London into China, and that gold is not being replaced. So that itself is something that could begin to impact the gold price in the near term and really at any point in time.
All right, thank you so much for that feedback there. Let's see, we just had a few more that came in. They're wondering if you would prefer long ETFs or big cap miners.
I think we'll have some opinions. Rick, what do you say?
Again, I think that depends on the investor. The investor willing to do his or her own work can often outperform the ETFs, but for an investor who wants to participate in the sector, I think ETFs are good instruments. They're low cost. Given that we're ETF providers at Sprott, we have our own opinions as to ETFs, and we would prefer factors-based ETFs rather than market cap-based ETFs, in the sense that factors-based ETFs take into account what we consider to be important fundamentals, like EBITDA relative to debt and EBITDA, that is cash flow, relative to enterprise value, and also production growth, so that you avoid the companies that are in effect cannibalizing themselves. But a carefully chosen ETF we think can perform reasonably well and can perform very well when compared to a portfolio that is constructed without the necessary work to construct an intelligent portfolio. So it really depends on the investor, not so much the product.
And I'll give Sprott a brief plug there. They've actually pioneered the use of these factor-based standards for a ETF of gold producers, and the premise, of course, being that a company that performs better on a business level will perform better on a share performance level. And I think that's borne out. Getting a bit deeper into that, I would not limit one's gold holdings to either ETFs or gold stocks, I again favor and recommend that there is some foundation to the portfolio that's actually physical metals that's put away in gold and or silver and is viewed as an insurance. You don't buy fire insurance for your home in the expectation that your home is going to catch on fire, but that's the same reason you should have some physical holdings of gold and silver.
All right, and it looks like one more question came in here. Let's see, they're wondering if you have any feedback on if it's a good time to buy RGLD.
I don't know that this is an appropriate venue to comment on such individual junior mining stocks. And I guess what I would do is urge the listeners to look at our individual newsletters for commentary on those stocks. In particular, they can look at Gold Newsletter for that particular issue. And Brent, I believe, has covered it as well. Anyway, I think, is that our last question, Mark?
That looks like that is the last one to come in there.
Good.
So that will be good.
Questions.
Yep.
And I'd like to thank all our panelists. I believe, Mark, you have some closing comments?
Yes, I'll go ahead and take the controls back here from you real quick. All right, and again, I know, folks, you did hear the mention of this cruise. It is going to be a fantastic lineup. I do have on the screen some more information for you, which you can visit the URL you see on the screen. There's also a free brochure and handout that you can download in the handout section in the GoToWebinar platform, or there's a QR code down your bottom left-hand side of your screen. You can scan that, get more information as well. But other than that, Brien, Brent, Mike, and Rick, I appreciate you guys taking the time out of your day and giving this fantastic presentation. Really looking forward to that cruise as well.
Thank you.
All right. Thanks, everybody.
Yep, thank you.
Thank you. All right, everyone, thanks again for joining us today. Great questions, brilliant minds on this panel here. Be sure to visit us at the URL on the screen for more information on that cruise. This event will also be on demand, so we will have that on moneyshow.com coming up in the next few days. We'll have a link out to you. You can also access it by logging on to moneyshow.com and viewing the on-demand session. There was a gold panel that took place a few weeks back, maybe a month ago. That is on demand on moneyshow.com. You can see that presentation as well. But again, this includes our live presentation for today. Thank you again for attending, and have a wonderful evening.